You can now get our automated supply and demand zone indicator for TradingView, and if you want to know more about this, check the link in the video description. In this video I will show you how to use the indicator, what is supply and demand, and how it may improve your trading. So we can turn on the supply and demand indicator, and then you will see right away you will get those supply and demand zones on your charts. If you switch to a different time frame, the zones will adjust automatically. This indicator works for forex, stocks, cryptos, indices, commodities, and any other market. It also works for any time frame, so whether you are on the weekly or all the way on the 5-minute or even lower, you can use the supply and demand indicator. Supply and demand may seem very similar to support and resistance, and the way you use it is actually quite similar. However, the way you identify supply and demand is quite different. And what you will see is that supply and demand zones often precede support and resistance. So supply and demand is actually what creates support and resistance later on. And if you know about a supply and demand area, you'll be able to spot important levels well before any trader, only using support and resistance. And the way you use it is generally once you have identified a supply and demand area, you will wait for the price to get back there, and then you look for patterns, trade ideas, breakouts for example, to then time your trades away from a supply and demand area. Of course, not always will a supply and demand area hold, and the market will sometimes just brush through it. But this is why we need to trade with confluence, and I will show you in a moment how to create a top-down supply and demand strategy where you can improve the quality of your trading. However, the supply and demand areas are very accurate, and you can often see strong reactions away from those zones, which can be traded then on a lower time frame, for example. You may use supply and demand right at the time frame where the supply and demand zones are created. So right now we are on the 1-hour chart, and you can see that after the supply zone was created here, the market reacted here very nicely again. You could have looked for a short here. Here was another supply area created, and you can see the market reacted here once and twice. Sometimes the market will come short of such an area by just 1 or 2 pips, but this is quite normal because the supply and demand areas are very strong areas of impact, and you will often see a radiating force around those supply areas. And I will show you in a moment how to trade them with more confluence. Here you can see a demand area was created, and the market then rallied higher off of this. Here a zone was created, the market showed a small reaction first and then broke through it later on. This zone has not been tested yet, so it's still fresh, as we would say, and this is how you could use it in the future. Wait for the market to get back to this zone, and then wait for the market to show you some type of reaction. Look for a pattern around it, look for any other price action signal, maybe even use the moving average or anything else that would help you then to time a bullish trend away from it. We don't recommend to blindly trade those zones, and always wait for confirmation around them, just as you would using support and resistance. Let me show you a very powerful top-down supply and demand strategy. So first of all, we turn on our supply and demand indicator. We are on the daily chart, is where we start our analysis, and you can see the market is very close to those 2 supply areas. They have been creating well in the past, however, the market has not been back there, and so we still consider those zones fresh. The market is not quite there yet, but let's see what happens afterwards. So the market with the next candle has touched the level, and the context of this market is very interesting. You can see the market is in a mature uptrend. It has been going higher for quite a long time. Also, when we look at the last 2 swing highs, if you would add an RSI or MACD or a stochastic indicator, this would give you a divergence. So it shows you that the market is slowing down. And it would make sense now in this context to start looking for reversal opportunities. So we could be very early on trading a new downtrend, and this starts on a daily time frame. So we have a lot of confluence factors. And now we want to drop to a lower time frame, for example the 1 hour, where we're going to time our entry. So this is how it looks on the lower time frame, and now we try to come up with a trading plan. How do we get into a trade? And when we see this, we can see here is a trend line. We connect the lows in the uptrend. We also see that here in this area there seems to be a very strong support resistance area, and a trading plan idea would be, for example, to trade a break and a retest here to the downside. So we would be very early on in a new downtrend for the best reward to risk ratio. Shortly after, you see that the market has completely gapped through the level, so this is already a very strong signal. Also, you can see now we see the head and shoulders pattern here very clearly. The head and the right shoulder are very far apart, which is a very strong signal that the uptrend here is clearly over. We have the breakout, so you have two options. You either go in right away or you wait for the market to retest this area and then you short off the previous neckline. So the market is back at the neckline now and it has almost closed the gap. So now would be an interesting place to go short. So we have a lot of context. We can trade with a high degree of confidence. Where we would put our stop loss, probably here just above the right shoulder. It would be protected now by this support level, by the trend line, and also here we are above the recent high, which gives the trade a lot of context. Then for targets, we have a few options. We look left and we could identify the last swing points here, for example, at the absolute low. Having a target at the absolute low or at the origin of this uptrend seems to be a little bit aggressive, so we don't typically recommend it, but you can go somewhere between the first and the second level. If you decide to get our supply and demand indicator, you will also receive an instruction manual and also a video that will explain a few trade strategies that you could use with the trade indicator as well. So now let's see what happens. We get a very decent reward to risk ratio of 3-to-1. And initially the market went against us a little bit. You can see the market did not reach the right shoulder. And this is something that you will see quite often. And this is why you need to place your stop loss away and outside of such a pattern, because retests are very, very common in these markets. The trade is unfolding very nicely. You can see this area would have been reached, but let's see if the ultimate target is also possible. And you can see shortly after the market would have reached here the midpoint between the first and the second support level. Let's keep following the price action. If you're not out of the trade by now, you have a few options now. You can see that the market is giving you this channel, and this could either be a continuation flag pattern or it could also be a reversal. We don't know by this point, obviously, because the market is still trading in the range, but you could use that in your trading as an indication. If the market breaks above this, get out. If the market breaks below it, stay in the trade. You could also think about scaling out of the position by now because there's a little bit uncertainty now. It's really up to you. And you can see ultimately the price would have broken out of the channel to the upside, reversed higher, came back all the way into the entry, and this is how it would look like. So you have a few options on how you can approach this trade. The break and retest is usually the preferred entry method, and then for targets, that is personal choice. Do you prefer wider targets or a little bit closer targets? You could add the manual exit here as well, reacting to price changes. But all starts with a higher time frame supply and demand area. It helps us identify where we should be trading, and this is how we improve our trade quality using the higher supply and demand areas. Let's look at a second trade idea, and I'll show you how to use supply and demand with a top-down strategy. So we're starting on the weekly time frame, and in general it's always good to start your analysis on the higher time frames, weekly, daily, and then we can go all the way down to the 1 hour, 30 minute, 15 minute to time our trades. The higher time frame levels for supply and demand really carry a lot of weight, and this could really improve the trade quality from you. So what do we have? The market is nearing such a big zone here. It's still fresh. The market has not been back here yet. So let's see what happens if the market gets there. So you can see initially we have a very, very strong bearish candle, so you definitely don't want to go long here. And this is why it's so important that we always wait for further confirmation. We don't trade those supply and demand areas blindly, although they are quite high probability. It is not good enough to just look at a zone and then trade as soon as the market hits it. We want to time our trade on the lower time frame for the optimal reward to risk ratio. And we want to wait to see, is the market actually reacting to the zone? Sometimes the market doesn't care about the supply and demand area, and we can avoid those easily if we wait for a little bit more confirmation. You can see the next candle looks much better. Now we have an inside candle, we have a bullish candle, and this shows a slowing down of the price action. Again, any indicator like the RSI, the MACD, stochastic would give you a divergence here as well. So it does make a lot of sense to look for a bullish opportunity on the lower time frames. We're now on the 1 hour chart, and this is how the weekly time frame looks on the 1 hour. And what do we have here? Let's first try to turn this off, and then we try to define the price action. What do we have? So it seems like the market is already making higher lows, and it is struggling here to get above the highs. And this helps us really a lot for our trading plans, because now we could use this scenario for a break and retest strategy. We wait for the market to get above this area to confirm a breakout. Then we want to see that the market is retesting this area, where we would then get into a trade. And those retests are really optimal because they help us improve our reward to risk ratio quite significantly. So let's wait for the breakout and see what the breakout looks like. Do we get a retest? The breakout has happened, and you can see in this example we have a very shallow breakout, so we could already decide to get into the trade. So if you decide to just go with a regular breakout trade, not retest, let's assume here would have been a theoretical entry. The stop loss could have gone here underneath the last breakout point, or if you want to be a little bit safer, you target away behind this low. For targets, let's turn on the supply and demand zones, and you can see that we have a lot of free space, so there's nothing here on the way up that could stop the price, except for this cluster here. You can see we have 1, 2, 3, 4 supply areas that are starting here at this point. So if the market gets here, it's probably going to have a hard time to trade through this area. So when we are in a long position, we definitely want to be out of the trade well before this area, because the moment it hits this area, there's a high likelihood that we will see either a reversal or just a very hard time for the price to break through it. So when you place your target, you could place it above or below this area. We would get very close to a 6-to-1 reward to risk ratio, which is really exceptional. And then let's see what happens later on. The market initially broke out and then is struggling a little bit. So you can see we have this flag pattern. And if you're not in this trade, you could, for example, decide to trail or to scale into the trade. A breakout out of a flag is often a very high probability trading scenario. You can see that the market retested the breakout area, and that is why we have put our stop loss to where we put it. It's always good to not put your stop loss too close to the price action and to the entry, because those retests are very common. And also, if you have such a wide target, it makes sense to give your stop loss a little bit more room to the downside as well. The trend is unfolding nicely and the market keeps making higher highs and higher lows, so nothing to do for us here. You can see the market is coming close to the lower supply area and it's starting to struggle here a little bit. What you could do is, for example, trail your stop loss. This would always be a good choice. For example, the market is offering us here this trend line that we could use. So trailing your stop loss along the way of the trend line would be a very reasonable way to protect your position here. And by now you would be out, so because the market broke the trend line, if you would have trailed your stop loss, this is where you would have been out. And this is a 4.4 reward to risk ratio, a very decent outcome for this trade. We started on the higher time frame and then timed our trade on the 1 hour for a very optimal reward to risk ratio, very nice trading scenario. Let's just keep following the price action, and you can see the market is struggling a little bit, so it's probably nice to be out of the trade. Even if the market would turn around later, you still wouldn't have to hold through this drawdown, which is emotionally very challenging. So it's better to take a profit where the market is offering you a decent reward to risk ratio and your trade idea is kind of invalidated once you see a trend line break.